Welcome back to Power Play on this Monday. We want to turn now to the state of the Canadian economy. We've got new data out from Statistics Canada today showing inflation rose 2.2% year over year last month, matching the October inflation rate, with lower travel and accommodation prices and slower rental growth putting downward pressure on overall inflation. But, and it's a big but, food prices remain stubbornly high, with food purchased from stores rising 4.7% year over year in November, up from 3.4% in October. And that's the biggest increase since December of 2023. With us now to talk more about the state of the economy and how it could impact your own budgets in the year ahead, Francis Donald is the Chief Economist at RBC, and Jean-Francois Perrault is the Chief Economist at Scotiabank. It's great to see you both. Thank you very much for making the time. Francis, I'll start with you. Could you help us understand why overall inflation has been pretty consistently within the target range, but grocery prices, it feels like just keep, and now we have evidence of, just keep going up and up and up?
I can understand why Canadians maybe don't feel too relieved to hear that inflation is just 2.2%. And that's because most Canadians aren't really living by the CPI or the CPI basket. It's the things that we purchase regularly and that we see prices of every single day that matter most to us. So food prices surging is going to be an important story for Canadians and one they've been experiencing for many years. I say the CPI basket isn't exactly how Canadians live, and that's because most of us don't live in year-over-year terms. We think about what prices looked like before the pandemic, and prices are up over 20% since before the pandemic, over 30% for rents and for food. And so it's normal to have a little bit of disjointedness between what we see in a CPI number and what we're actually experiencing in real life. Now, food price inflation is coming from a series of supply side factors, from droughts in Vietnam and Brazil impacting coffee prices to bad weather in Western Canada impacting cattle. So there's a variety of cross currents coming through here, and all of them come down to what Canadians are paying in the grocery lines and how they're feeling affordability in their day-to-day life.
Jean-Francois, given those cross currents in the supply side factors that Francis is outlining, should we be kind of preparing ourselves for more of it next year?
Well, certainly when you think of the things that Francis indicated as drivers of the food price increases that we've seen so far, a lot of the things have got legs to them. So we know that they're going to put upward pressure on food prices as we go forward. If you think, for instance, of the hog cycle or how long it takes to raise cattle, we know that is going to take put upward pressure on beef for quite some time. And as a result of that upward pressure on other types of meat, as people shift away from the things that are more expensive. So it's a generalized trend that we're seeing of higher food prices that I think will extend well into 2026. Now, at some point, the idea is that as food prices continue to rise, people cut back on their consumption of certain types of things, which of course we don't want to do because it's painful, and that will eventually put downward pressure on prices. But it's the game seems to be kind of cooked for the next few months at the very least.
There's a whole bunch of different data sets that we're getting over the past few weeks, I would say, but even like a month, Francis, that we all, I think, as Canadians look to try and figure out how the economy is doing. But I find it personally kind of confusing because, you've got GDP growth in the third quarter, but flat business investment. You've got employment growth that's outstripping what the anticipation or the expectation was. But at the same time, you have, a number of other things that I think people are, like even consumer consumption that was flatlined in the third quarter. So if you were to write a headline about the economy right now, what would it be?
I would call the economy fragmented. The hard truth is, while we like to aggregate all provinces and all households and all businesses into one number, Canada is not just one economy, particularly with the trade shock that has come through that has predominantly hurt southwestern Ontario. It's been incredibly damaging to sectors like steel, to cities like Windsor, Ontario, whereas there are other areas of the country that have been largely unaffected. And so you end up with this sort of, your head's in the oven, but your feet are in the freezer, and on average, you're okay. And so far, it doesn't seem like that average makes sense to anybody's individual story. Now, underlying that, we know that there are different households that are feeling this economy differently. Lower wealth and lower income Canadians are really being hit harder by things like food and rent prices that have come up so much more than average prices. So they may not see their experiences reflected in, of course, the strength of the stock market. So we have to move away from this idea that one GDP number tells the entire story of Canadians and their economy and start realizing there are so many underlying economic stories. We just kind of have to work a little bit through lunch and realize that there are details beneath some of these headline figures.
Relative to, though, if you did try and take a bigger picture view, Jean-François, relative to the expectation we would have had a year ago when exactly at this time Donald Trump was calling us the 51st state and saying that these tariffs were coming fast and furious, and there was a ton of uncertainty around that. Like, relative to that expectation, how would you assess the performance of the economy?
I mean, there's no question we've done a lot better, right? But that's in part because the threats were the bark was worse than the bite in some sense. This time last year, I guess early this year, the threat was 25% tariffs. If that would have occurred, almost certainly we would have had a recession. So measured against that bar, yeah, we did great. There's not a recession. Growth is 1.5% or so this year. As you said, we had a pretty strong third quarter when you look at the big picture GDP data. But that's nothing to write home about. 1%, 1.5% growth is not great. It's just not as bad as we'd feared. Now, as Francis indicated, despite the fact that we're seeing kind of a little bit more momentum than we would have feared, the reality is that the economy is still very difficult to read. We're getting these kind of strange readings of, for instance, very strong job growth over the last 3 months, despite domestic economy that's struggling, despite what we know to be household and business confidence, not doing particularly well. So there are these kind of puzzles, even within the fact that the economy is a little bit stronger than expected, that are making it hard to understand really what economic dynamics are here. Like, why are firms hiring as many people? Are they in fact hiring as many people as the economic data suggests? And those things are really important because they condition how the Bank of Canada's going out there to help us. If the job market is giving these signals that, hey, we're creating tons of jobs, because that's what actually the numbers suggest, that puts the Bank of Canada in a very different spot in terms of helping Canadians manage through the cycle that we're experiencing, even if inflation is, in the upper half, we'll say, of its target range. So it's just a very complicated and difficult situation to read, because indicators suggest all kinds of different things depending on how you look at them.
I've just got a minute left, but how do you, what do you attribute to the relative resilience, despite, all of the complications that both of you alluded to, Francis? Why did our economy remain as resilient as it did?
Well, I have to agree with Jean-François. The actual tariffs being applied to Canada are much lower than we expected back in February of last year, or much more than most initially thought would come through. Remember, 86% of our exports are not being tariffed at all. And on top of that, we've had rate cuts. We have that mortgage cliff that everyone is so worried about is a little bit more like a mortgage hill right now. Household balance sheets are doing better because of the stock market. And we have had fiscal support coming in at both the provincial and the federal level. So there have been supports in place to really mitigate some of this shock. But again, I have to highlight, there are places in this country that are doing and really suffering because of the economic shock. Right. So to say that on average we're doing better than expected, that's really good news for a lot of Canadians. I hope it brings some of that Canadian consumer and business confidence back, but it doesn't tell every Canadian's story. There are still trade shocks in play, and that there are those that have yet to play out as well.
Yeah, super good point. Okay, I'm going to leave it there. Thank you very much, both of you, for making the time for the conversation. I appreciate your analysis this evening.